In this video, we are going to mainly talk about net operating income approach. That's the one which is with the abbreviation NOI, and net income approach, which is on the abbreviation of NI. So we want to just see what these approaches are about, what are their major assumptions, and with an example so that we can appreciate what these approaches are all about. So let's get into it and understand the two. Let me begin with the first one, net operating income. What is this approach all about? Well, this approach takes it that the cost of capital of a company or a firm remains constant in any given situation. Maybe you might have an increase of debt, you might reduce your debt, but this assumption of the NOI says that this particular cost of capital remains constant. This is one thing you have to know from these assumptions it takes. Further, another thing you look at is that the market value of a firm or a company also remains constant. So these two that I've mentioned here in the screen, they are all constant. So that's what this is all about. But issues like the cost of equity, that one does change in this theory or this approach. This one changes. And then, yeah, so mainly this is what you need to know from this approach. Cost of equity changes. Our market value of the firm remains constant. Cost of capital changes, so remains constant as well. So just remember constant for those two on top. Yeah, so now let's try and see an example to demonstrate that for sure these assumptions hold true. Well, I'll give you the following example where I would say we'll say that a firm, assume that a firm has got 600,000 kwacha in debt, which is going at a 5% interest rate. And then one other thing we'll look at is that the EBIT, earnings before interest and tax, that have been given for this firm is 2,000 kwacha. Another one we'll look at here is that the firm also has a cost of capital. We are outlining with KO. The cost of capital is 10% for this firm. Then they ask you calculate the market value of a firm. So first of all, what formulas are we supposed to even use? So you also have to acquaint yourself with the following formulas, by the way. So whenever you're being asked for the market value of a firm, there's this formula that can help you. I'll give you two, by the way. So market value of a firm is equal to B standing for debt plus S for equity. Okay, so B stands for debt while S is equity. That's one formula you can use. So basically, you will get the total debt. Like for example, in our question, the total debt is 6,000. So that's the one you would put on the B part. Although they have not yet told us the value for S, which is equity, but we can easily find it. So it's like the moment we just find the market value, we can just come and even substitute. Or yeah, I'll show you anyway another alternative formula. But for now, I want to show you the other formula. This is formula 1. Formula 2 for market value is as follows. The market value should be equal to EBIT over cost of capital. So you will notice that in our example given, we have been given the EBIT. We have also been given the cost of capital. So you can easily come and substitute in method 2, which will be as follows. 2,000 was the EBIT. The cost of capital is 0.1, which is just 10%. I've been changed to decimal. And therefore, it will give us a market value of 20,000 kwacha. And you have answered the question if you have been asked. So if even though you are asked, oh, what would be the equity part, the equity, you just go back to maybe Formula 1 there. You just follow the arrow. You go back to Formula 1 there, and then you just substitute and so for S. Yeah. So these are some formulas you need to get acquainted with. Another formula just before we leave, this is a formula for cost of equity. Cost of equity is signified by KE is equal to earnings available to common stockholders over S. What does this EAC mean, the one on top? Well, to break that EAC down, it just simply means EBIT minus I. Okay, EBIT minus I. That's what your EAC stands for. Because remember, from your net operating income, this assumption by nature does not include taxes. Because if you're looking at a capital structure, because by now at this point, for you to be taking financial management, you should have been well acquainted with the other sister course, which is corporate finance. Yeah, where when you're creating your capital structures like this, EBIT, interests, then you have your what you would call earnings before taxes. Yeah, this one is, you also call it your net operating income, this one, because it comes before the tax parts. Yeah, so this assumption, you can tell that it does not include taxes. That's another reason I wanted to add for you. Yeah, so let's get back. Okay, let's get back to this one, because basically net operating income, you should understand it as just an amount that comes before your taxes. Yeah, so let's continue now. Then we proceed to, let's also get the value for KE, so that we will come and observe that for sure KE does change. So we said KE is equal to EAC over S. Where at this point, do we even know EAC? Yeah, we do. It's EBIT minus I. What about S? S will be found very easily since we know the market value of the firm. So remember the market value formula, the method 1, B plus S, meaning the B part is the debt, 6,000 plus S, that's S, we'll just solve for S. And then you have your 20,000. When you change the subject, you find that S is 14,000. And that's your value for S, which you now take into that formula right above. So you even say, therefore, the EBIT minus I, what's your EBIT? 2,000 minus I, what is I? I is interest. Remember there was this part. Let's go back to the first here, the example. There's interest of 5%, this one here, the one I'm trying to just circle right now. Yeah, that's interest of 5%. So if you charge that one on the 6,000, what are you getting? You should get about 300. Yeah, so that 300 will then be used here. Let's get back to where we were here. So 300 over 14, which is your S. Then you solve for KE. Therefore, what is your KE equal to? 12.4. 14, sorry, percent. So that's your KE. Remember all these answers we have found. The KE over 12.14, and then this approach says that KE changes, right? But they say market value and cost of capital don't change. Let me change some figures now and see if this assumption holds true. Let us now say that the value for debt is 10. Okay. Let's now say the value for debt has now been increased to 10. Wow. They have bought back some shares from 14 to 10 as well. Okay, they've bought back some shares to 10 as well. So let's say debt is now 10,000, and then they have said that they have bought back, when they buy backs like repurchasing, bought back shares from 14,000 to now they are now at 10 to 10. So let's recalculate the following things. Let's see what will happen to the cost of equity, the market values, and whatnot. Well, the market value, we just use method 1, which is B plus S. 10,000 plus 10,000. This gives you 20,000. What about for KE? That's the cost of equity. The cost of equity, the formula still remains the same. EAC over S, where ES is just EBIT minus I over S, where EBIT is 2000 minus, what is I? I is the interest rate. Remember, the date has now changed. This time around, the 5% is being charged on the 10,000, because always we're charging it on the value of date. So that's 1,000. That should get this side 1,000. Then yeah, over what? Over 10,000, because that's now the new value of equity as well. Yeah. Answer. What are we going to get as our answer here? Because our interest rates, sorry, did I calculate that well? That was 5%. Huh? Just I beg your pardon on that one. 5% of 10,000 is 500. Yeah. Please just excuse me on that one. Yeah, so now we recalculate KE. So therefore my KE here will give you what? 15%. Yeah, it will give you 0.15, but I've just converted it to a percentage. Yeah, so that's the answer. You've noticed that KE hasn't remained constant after given that you make some changes to your capital structure, right? Like you've increased the debt, you've reduced equity. You've noticed that KE has changed. The market value remains the same. That's what this approach is all about. Have we proved the cost of capital yet? No, we haven't. Yeah, so remember the formula that we were using initially for market value calculation, this one, over KO, which is the cost of capital. We can use this one and solve for cost of capital. EBIT over MV. We can do the needful. EBIT is 2,000. What is the market value? 20,000. Therefore, KO, which is the cost of capital, is 0.10, which is 10%. It too remains constant. So that's basically the logic behind the net operating income approach. Let's look at the next approach, which is net income. Now, looking at this other approach, NI, it's just like the opposite, because your cost of capital this time around will be changing. Your market value will be changing as well. Your cost of equity this time is assumed to be constant, and the debt one as well. Let me just rewrite that clearly. So these are the following changes according to the net income approach. But the net income approach is on two aspects. There's one with tax and the one without tax. So just expect questions to come in that manner, because again, I'm going to just give you another refresher that from your capital structure knowledge, this is usually how you would make a normal capital structure. Then you have your tax and you have what? Net income. So you can actually just have net income even without tax. That's what this theory goes about. You cannot have tax and just be highlighting this in another color, such as seeing. At times when there is no tax, the one labeled in orange. And then there are times when you will have your tax. That's what this approach goes by. But the whole point is, these are the following assumptions on your left hand side of the screen. So what I'm going to do is I'm going to give you yet another example. Yeah, so this time around we'll assume like constant KE over 10%. Let's just use favorable figures so that it's easy to get the concept. And the market value will need to be calculated. Let's just put a question mark. We also need to get this one, cost of capital. And we'll assume the same one. I think let's just maintain the same 5% cost of debts. Yeah. Then let's calculate the following, which are in question marks. How do we get the market value? Well, I gave you two formulas for market value of the firm, B plus S. It's the same ones. The approaches are just different with their assumptions, but the formulas remain the same. So you go back. What is the B part, which is the data? Oh, we didn't give you the value of debt. Okay, here again was supposed to be given in the intro. So in my example, let me tell you the value of debt will also be maintained with the previous question, 6,000. Yeah, so let's continue now. We have 6,000 here. Do we know the value of S? No. What are we going to do? Remember, there was a formula which I gave you earlier on that had S. This one. So you can solve for S here. You just say S is equal to EAC over KE, where all these are given as follows. Let me just give you EBIT, because EBIT is part of EAC. let's also maintain the same one from the previous example, 2000, so we don't go far with new figures. Well, the EAC in this case will be EBIT minus I, if you still recall from what we mentioned earlier, over KE. Substitute, you have your 2000. What is the interest? Remember, the interest is 5%. That's the debt one. 5% of what? Of the debt value, which is 6,000. That's going to give you 300. Then you're going to divide that by KE, which is in just change it to decimal, it's 10%, but in decimal it's 0.1. Therefore, your S is 17,000. And you go back up to the market value formula and substitute now. You have your value for S. What is the market value now? 23,000. Have you seen what has happened? The market value of this firm is now at 23. Okay, let us see when something else changes in this capital structure. Let's assume now that debt goes to 10, just a similar one to what happened in the previous example. Debt is now, which is our B, is now 10,000 kwacha. Same K, the KD, which is just the cost of data, 5%. Your cost of equity is also maintained. We said in this theory it's constant. And let's continue with the same EBIT as well, which is how much? 2000. Yeah, then we try and resolve the market value of the firm. So MV is equal to what? 10. And by the way, in this theory, we've first increased debt to 10, and also we want to also take the same S to how much? So we want to also reduce S. Okay, so now what will be the following values? Let us recalculate this and see what's going to happen. Market value B plus S, 10,000 plus 10,000. Here it has gone down the market value. Next, we need to now adjust, because just a minute, here we had we've increased it, but want a constant change in the capital structure, because if we change it like this, is an imbalance in the capital structure. So you remember debt was at 6,000, that's going to 10, right? That's an increase by 4, because what we're trying to balance is we increase debt by 4,000 and we also reduce equity by 4,000. So initially our equity was at 17, right? Yeah, initially it was at 17,000. So now we want to just retire some or buy back some of the stock. Yeah, and we'll do the following. So if anything, let us just solve for S. Yeah, then we'll just start recalculating every other thing. So let's solve for S first. So S, we know the same one where we change the subject. This is the formula. Then we just substitute. We know EAIC is EBIT minus interest. Remember, interest is the 5% multiplied by what? The value of data. The value of debt is 10,000. So that's like 500 over cost of equities remains constant at 10%, giving you 15,000 kwacha as the value of S. Having gotten the value of S, we can even now find our MV at B plus S, which will be 10,000 plus 15,000 kwacha. 25 is the value of the market value of the firm. So what has basically happened is that the market value of the firm has gone up. Yeah, so you can notice that when you're even increasing debt, you can see the impact that it does have on the market value of the firm. So here the assumption was that they increased debt, and then you want to see what's going to happen. That's how you can understand this. So our main target here was mainly to see how this NI approach works, that it changes the market value. The cost of capital should also change. Let's see. The cost of capital, that's how much in the previous one. Did we even solve it? We need to also solve for that one, because it's in this formula as well, where KO is equal to EBIT over MV. So it's just that other formula which I started with, that V is equal to EBIT over KO, like if you rewind the video, but I'm just changing the subject of the formula around this formula. So EBIT, we said it's 2000 over MV 25, the one we just found. Therefore, what is your cost of capital? This can just be rounded off to 8%. Yeah, so that's your 8%. What about in the previous one? Do you think I should it? Let's just take you back. Here, we didn't find the cost of capital here. Cost of capital in this other scenario, when we didn't change anything, we said EBIT over MV. So EBIT is the same 2000. MV previously was 23 on this part before we changed the assumption. We're still under NI right now. What answer is it giving us? 8.7% as your cost of capital. But now it's at what? 8%. So you can see that for sure there's that difference in the values. They do change given certain changes in the capital structure. So you understand this. What in effect will happen to your debts over equity? Because debt over equity or debt to equity ratio is debt over equity, that's the B over S. So you know your debt value is now 10,000, your equity value is now 15,000. So you can even tell now that you have 66.67% debt. But previously, before we changed debts to 10 in this other scenario, what was our debt previously? It was at 6,000 and equity that time it was at 17 in this same net income approach, which we're just from doing recently. What was the debt to equity ratio in this scenario? It was 35.29. So another reason you can also get from here is that when debt is increased, you will also be increasing your debt to equity ratio, because that one just tells you how much debt is being used in a company, how geared is this company. And if it's high, that just shows you that the company uses a lot of debt and it's a very, very risky firm to even invest in. You can tell from such. Yeah, so you can even illustrate it graphically. The cost of equity line is constant under the net income approach. Even the cost of debt constant, but your cost of capital reduces as you increase debt. If you've noticed, it was reducing. Initially it was at 8.7 and now it's at 8% after the increased debt. And these are some things you can understand from the assumptions of it too. Yeah, so basically that's that on this video. Yeah, hopefully you find this helpful.